So I'm 35 years old, and I want an exact same benefit as a 25-year-old. Whose is going to cost more? Good morning. Welcome. Welcome to class today. Today, on the board for the Impact School of Money, we're going to be talking a little bit about insurance basics. Similar to what we did with mortgages, we're just going to get some terms out of the way, I guess you could say, so that we can understand a little bit better as we launch into different classes that have to do with insurance. So a couple of insurance basics that we want to cover. Number one is you have the insurer, the insured, the owner, and the paid. Okay, and so the whole purpose of insurance comes from these first two. The first two on the list, the insurer and the insured. Okay, so here's some responsibilities that I have. Okay, I have a car that's worth $12,000, and I have a house that's worth $250,000, and I have my health. That if something were to happen to my health, I have to go to the doctor, and that costs money, right? And I don't know how much it's going to cost. I'm not sure what the cost is going to be to repair my car, repair my house, replace my house, fix my health. I don't know what that is. So then I look at my bank account, and my bank account has this much money in it, let's say, and whatever these responsibilities are, or perceived responsibilities, could be something that size or bigger. And so the whole purpose of insurance is to fill the gap. And so this gap here is insurance. And so that's money that I don't have in the bank that somebody needs to come up with in order for me to come up with the money that I need to cover that responsibility. So that's where an insurance company comes in, or the insurer. So the person is going to be the insured. So let's say this is me or another person, and the insurer is the person that filled in that gap. So then people say, well, here's me with no money or some money. Where does this insurance company come up with all this money? And that's not what we're talking about today. That would be a whole nother class, but really the most simple way, and the way that people are going to describe where it comes from, is that you have all these people that there's a pool here that is going to pay for these responsibilities, but then there's people that as they earn money or they have money in the bank, they're putting money in to the pool. And so the insurer goes to the people and says, hey, we're going to create this insurance. We're an insurance company. There's all these laws and things they have to follow, of course. And as people put money into this pool, if you were to ever need some of the money, we will use all this money that's in this pool to pay for these responsibilities. Now, of course, they have these super smart people that work for insurers or insurance companies called actuaries. And what actuaries do, or they're the people over here that are really good at math. Not only good at math, but understanding risk, and the risk that a person at a different age and different health, how risky they actually are. So you have a young, healthy person. The risk of them having health or death challenges is very low. But you look at a young person that just got a driver's license, those that have teenage drivers will say, yes, I agree with that, is the risk of a young driver, again, the risk of somebody young dying is low, but the risk of a young driver getting into a car accident is high. Therefore, you have an older person with a good driving record, their car insurance is lower. The cost of insurance is lower. But then a older person that even though people say, well, they have a history of not being sick or they have a history of not dying, so why does their life insurance go down over time? Well, because you're closer to death. It's not guaranteed you'll be in a car accident, but it's guaranteed that you're going to die, right? And so that's what the insurer does, is they fill in that gap, and in the majority of the money that's used for this, a lot of it comes from the people that are paying for the insurance for the just in case, because that's what insurance is. We don't know what that cost is going to be, and so instead of just being in debt for the rest of our lives, is we pay for insurance to fill in that gap. So that's what the insurer does, is they're a company that fills that gap. The insured is a person that receives the benefit upon whatever event being triggered, whether it's car, health, life, homeowners insurance, whatever it is, that then the insurer, the company, will pay out a claim, a benefit of some kind to fill in that responsibility. Okay. Most of the time, going on to the third word here, most of the time the owner and the insured is the same person, but not in every case. So, for example, I get a life insurance policy on my daughter. She's the insured. Prudential, say, is the insurer. I'm the owner, so that I can call and make changes or make adjustments or address changes and all that stuff, and I'm the owner of the policy. And that could be a business. A business owns insurance for the employee. An LLC owns the homeowner's insurance on all the properties, or liability insurance, and that's the owner. And then a lot of the time, the insured and the owner are the same, and a lot of the time that same person is also the payer, or payor, or however you say that. I think I spelled that right. I don't know. And so the payer is going to be, of course, that would be the person that pays for it. And so the reason that they have those different terms is because sometimes the payer is not the owner, and sometimes the payer and the owner are not the insured, and all combinations of all of them. So let's say that I'm the owner of a policy, so that I can make changes and adjustments, whatever. My daughter's the insured, but then my parents, grandma and grandpa, they want to pay into it. They want to be the ones that pay for it. They could be the payer. I could be the owner. Daughter could be the insured. Can you do that? Yes. Okay. But then there are certain stipulations depending on what it is, you know, business, etc., who can be the owner, the payer, etc. But just to learn some insurance terms there. Okay. So some additional terms when it comes to insurance is you have the benefit, you have the premium, we have another word in there called the deductible. So we have a benefit, a premium, a deductible. Okay, so what is the benefit? So the benefit is going to be the amount that the insurer pays out when a certain event is triggered. So something we're dealing with right now, there's strong winds in the city that I live in, often. And we have a south-facing slope on our roof that when the wind blows, sometimes it catches, gets underneath the shingles and blows the shingles off the roof or bends them or whatever. And so my homeowner's policy has a benefit in it that says if there is wind damage, that they will replace up to X amount of whatever with this exclusion, that exclusion. And insurance sometimes can get pretty complicated. But basically the benefit is the money that would be paid to the insured. Okay, that's going to be the benefit. So you have a death benefit in life insurance. You have a homeowner's policy that has a benefit. You have car insurance where you have certain coverages where there's the liability only and the full coverage, but then there's different levels of full coverage that you can get different levels of coverage inside of that. But then there's a benefit that pays out, right? And typically the benefit is mirrored in the premium. The higher the benefit we have, the higher the premium is going to be. And a premium is the amount that is paid, usually measured annually, not necessarily paid annually, but measured annually, in what these actuaries feel is the right amount to pay into the pool to make it so that for a person of that driving record or that health or that life expectancy, that there's enough for the other people in that pool, and older and younger and other risk classes, that they can be paid a premium, a benefit, and there's enough premium going in. So, for example, I am 35 years old in about, well, I guess 19 days. In 19 days, I'll be 35. So, I'm 35 years old, and I want an exact same benefit as a 25-year-old. Whose is going to cost more? Well, mine is going to cost more just because I'm older. If me and the 25-year-old were the exact same height, exact same weight, exact same health, exact same everything, mine is going to be more just because I'm older when we're talking about life insurance, that is. Okay? So typically, like I said, typically, the bigger the benefit we get, the more it's going to cost, but not necessarily with car insurance, because the older you get some discounts at like age 26, and if you get married, and et cetera, et cetera. But again, just we're talking typically, the cost is going to go up as the benefit goes up. Where it does do that is, so I'm 35, and I want to get the absolute minimum coverages for my car, which in Utah I think is $5,100, I think. And so let's say that's what I'm paying for, and we'll talk about car insurance on a different day. We're just talking basics right now. And so I get that basic coverage, and I might pay $85 a month, $100 a month. Well, let's say I'm driving around and I see a lot of Teslas around, and I see a lot of Lamborghinis around, and I'm starting to see more, Ferraris or whatever. And it's like, if I got in a car accident with one of those, I don't think my minimum coverage is going to pay for that. So I can up my coverages, but by upping my coverages, same driving record, same person, same everything, the cost of the insurance is going to go up because I have more coverage, right? And so I have more. Same thing with life insurance. Same thing, as I get a bigger benefit, my cost is going to go up for that benefit. So, last word on here is a deductible. What a deductible is the money that I have to come up with before the benefit is paid. So the money that I pay before the benefit's paid. People say, well, haven't you been paying a premium this whole time anyway? Why doesn't that just cover it? Well, sometimes it does. For example, if I get a really low deductible, my car insurance, which means my out-of-pocket is really low, then my cost per month goes up. So they're going to make sure that they're making back that deductible in my monthly premium. Well, if I get a higher deductible, those that are dealing with open enrollment or health insurance or whatever know that the higher the deductible, usually the lower the premium. Is that always the case? Not always the case, but in a lot of cases, it is that the higher my deductible is, the lower my premium. But that's what a deductible is. So, for example, going back to the roof example, our homeowner's policy has a deductible of $500. So even though it's going to cost, say, $3,000 to replace that side of the roof, and I've been paying a monthly premium for my homeowner's policy for 5 years, then I still come up with $500, and then they cover the rest, which the argument is, well, if you've been paying X amount for 5 years, aren't you sort of covering it? Well, yeah, but isn't that what the purpose of insurance is to potentially and hopefully use it? To not just pay and pay and pay and pay and pay to not get a benefit out of it. You know, we're not hoping we get in a car accident. We're not hoping that the shingles blow off our roof. But if they do, that's why we pay into it, so that we can then be the beneficiaries of the money that was paid in. Okay, so I guess we should add that word up here to our list of people. Is you have the beneficiary that is the one that's going to receive the benefit when a certain event is triggered. And again, there's kind of two definitions, I guess, of beneficiary. You have the actual. It will ask, who would you like to be the beneficiary? So say like on a life insurance policy. Well, the word beneficiary is the person that benefits from having that coverage. So, for example, do you designate a beneficiary on a health insurance policy? Do you designate a beneficiary on a car insurance policy, homeowner's policy? No, but who is the person that benefits from having the coverage? Does that make sense? So, having received a benefit from having the policy. So, thank you for coming to class today, to the Impact School of Money. Class dismissed.